Well, hello everyone. It is 2 o'clock Central Time on Tuesday. So obviously it is time for this week's installment of our multifamily um, investor education podcast. So welcome to the Passive Investing Made Simple podcast. I'm your host for this week, Rob Gallo. I'm the Director of Investor Relations at PassiveInvesting.com. Whitney is currently at a conference and representing PassiveInvesting.com, and we wish her luck. I'm obviously very happy to be here to share some of the ins and outs from my perspective of passive investing. And I want to make sure that if you haven't already done so, that you check out passiveinvestingwithwhitney.com. You can you can access all sorts of important resources there and tools really to help you underwrite your next passive investing deal, review your current deals, and really just if you'd like, schedule a one-on-one session with the guru herself, Whitney. So please check out passiveinvestingwithwhitney.com so you can learn more on that information. So I am very excited to speak to you today about today's topic. The topic today is avoiding common real estate debt fund mistakes. What we're actually going to go through are a couple things. One, I'm going to make sure that you kind of have an understanding of some of the things that I look out for, as well as some of the things that I've heard in the industry when actually evaluating a debt fund and actually, the deal itself. But the other piece I'm going to point out today is also, if you're currently in a debt fund, when should you start to get a little concerned, right? When should you start asking some of those deeper questions about, hey, what's going on? Why are we having problems with maybe some of the loans that we're seeing? We're getting that non-performing loan kind of creep up. So hopefully at the end of this, you'll have sort of a good little package of these are some of the questions I should be asking or I should be watching out for when I'm evaluating a debt fund, as well as some of the questions that you should be asking when you're in a debt fund and maybe you have some concerns from that. So first and foremost, I just want to say I am not a financial, legal, or tax advisor, and that you should consult with your financial, legal, or tax advisor team or individuals before making an investment decisions. Again, as I said, the information that I'm sharing with you today are from my experience, my perspective, as well as just kind of understanding from the industry and being an industry insider on those pieces. Next slide. Just quickly here, we'll go through our agenda. I'll just give a little more introduction about myself. What is the debt fund and when to avoid real estate debt funds? And the other thing is that any issues that can signal trouble as you're looking for some of these funds. So background of myself, that's a picture of my wife there. I've been married for, almost 15 years. We have 2 kids there. That was on one of our trips. We love to travel and when we can with our children. Previously, I was a consultant, financial healthcare consultant for 18 years. I've been an active and passive investor for 12 years. I've actually been quite connected with passiveinvesting.com for those 12 years because I was individually one of the first investors to invest with one of our managing partners, but I've really been a passive investor with them, as well as sharing some other insights along the market as we've gone through the years, and first started with passiveinvesting.com of April of last year. Obviously, you can see I've got an MBA from the University of Chicago, and it's really some economics and real estate has really been one of my passions. I am an active investor with some of my family members. That has its own headaches, as I'm sure some of you also do as well, but we focus on Airbnbs. All right, so let's kick in. What are some of these debt funds that we're talking about? So first and foremost, what is a debt fund? So a debt fund is an investment pool in which the core holding comprises of fixed income investments. So in reality, this could be multiple pieces. This could be actually focused on bonds. This could be focused on real estate. So we're going to stay really in the real estate realm for this. So types of real estate debt funds that, I see and you probably see on the market. We've got mortgage funds that really just focus on, buying basically the mortgages and then basically being the holders of those mortgages. So you're kind of acting as the bank in that perspective. There's a bunch of commercial and residential real estate debt funds that you can get into, as well as real estate loans, where you can either be a first position loan or even, there's some other pieces here where you can be a mezzanine debt fund where you only focus on the mezzanine layer. So you're not first position, but you're second position, and really in there to help the organizations or that real estate with any of their additional needs. So today I really want to focus on kind of the real estate areas of the debt funds, and I'll also provide a couple other interesting pieces that I've heard kind of throughout the time here. And I'm going to wait to hold questions. I'll answer them at the end of the piece here. So when to avoid a real estate debt fund. So again, this is sort of a quick list that, in terms of kind of what I've seen in the market and what I've heard, and just also borrowing some things from some of our other areas, like our 8 red flags that we have for investing in passive investing. So this is not a complete conclusive list, but just some other areas to make sure it's part of your checklist when you're actually evaluating a debt fund. So the first piece that we have here is a single managing partner. So I think it goes without saying that preference is to have at least 2 partners and actually 2 unrelated partners that you should invest with, just because in reality, you should never invest with an operator if there's only one partner. I think we all have had an experience with someone, or at least I know I have, where an investor invested with a partner that was just a single holding partner, and they invested $200,000, and they even got a friend to invest $200,000, and that single partner basically, when times got tough, he ended up ghosting them. And in reality, it's 6 months later after that specific example, and they can't actually find that operator. So make sure that if there's more than one, it could be 2 to 3 unrelated managing partners, that percentage likelihood of people ghosting you really goes down. The next piece that I really focus on when evaluating a debt fund is I want to be careful for debt funds that have managing partners or teams that really have little to no experience in that space. So I know this is probably, well, that's a no-brainer, right? But I think in a lot of times when we speak to operators or we speak to other, debt fund holders, they get so excited about debt. Maybe they have a good experience in one space and they say, hey, you know what, we're going to then go into this other space because we see that there's debt there and we really like that. What really kind of bothers me is that people think that, okay, yeah, if you're doing, let's say, single family loans on rehab projects, and hey, you're really good at that, and now you're going to go into multifamily loans of, doors of, 200, 300 in that space. There is a level of experience and difference between a single family home in the multifamily space. Yes, there's obviously some overlap in terms of what that is. But what I like to look for and what I like to see is that they have experience in, that specific asset, and an experience more than necessarily, hey, we started a debt fund. I want to know that they've owned those types of assets, that they've done some maybe hard money lending to those types of assets, to really understand kind of what their background is. And really what's further is that they have experience when the market's been down. So what did they do when that market was down in that space? And how have they actually changed their outlook, their investment strategy, all of those pieces to make sure that, hey, I've learned some lessons from those downturns, and now that's baked into my new debt fund. So that's really a key important piece. The next item that I wanted to pull out, and this kind of is, really tracing after that no experience in the space is an unclear or broad investment strategy. Again, I really want people to focus on one thing, one asset class, one even type of that asset class. So they're actually really focused on doing that well. I've seen a lot of debt funds come in and they say, yeah, we're just an overall debt fund and we do single family, multifamily. We also do some mezzanine debt and we'll do some, small business loans as well. That's great. But what I then would ask is, okay, tell me each one of your team members that has that specific uh, knowledge and experience. But then again, how are you managing all that? So, not saying that it's bad that they have a broad investment strategy. It just would bring some concerns to me to say, well, it seems like you're too broad in that specific debt fund. And why didn't you just break those out as different debt funds? So just, make sure that you have a good understanding of that. The next one that I look at is really that unproven track record. So, doesn't necessarily mean to say that, hey, you don't have necessarily a proven track record in here, but it's more to the effect of saying, show me this track record that you're saying you have. Okay, you said that you've done 12% over the past 2 to 3 years that you've had this fund, but show me and tell me how that track record has been proved. What are the processes that you've put in place to actually understand to keep those pieces there? What are the things that like, and even speaking to some of the other folks that have invested with your deal, that they've been confirmed? Because in some cases, like I heard a debt fund, they were basically putting in and saying, yep, we'd hit 12% for all of our distributions. Well, when they actually reached out to some of the investors, they, yeah, we got 12%, but they were late on their payments by 3 to 4 months, right? So it's just making sure to understand some of those intricacies and saying, okay, prove your track record. Let me understand how you've done it. What are the processes you've had in places? And let me speak to someone about it. The next piece that I like to vet when researching a debt fund or asking questions is to make sure that the managing partners, whoever's trying to sell that debt fund to me, that they can actually articulate the risks and then how to mitigate those risks. I think there's a lot of cases that people come up and say, well, it's debt. It's sitting here, basically first position or right behind that first position. And yeah, it just gets paid. Well, that's not always the case. And there's a lot of risks that, one, that organization and that debt fund has to take, that they are impacted in order to make sure that we as the investor actually realize those distributions. So a key piece to watch out for, if a manager or someone's telling you cannot articulate those risks, and they can't actually tell you how to mitigate those risks, that's another warning sign that you was like, hey, maybe I needed to ask more questions or take a step back on that debt fund. The next piece that I like to point out, and this isn't necessarily a bad thing, but it's making sure that you have a complete understanding of what's going on with the fund. So a lot of funds out there use additional leverage. And what that means is they could do it in, two main ways that we have. One is that they utilize a line of credit. And a lot of times what happens when you utilize a line of credit, in a debt fund, you're basically ensuring that your redemption period, people can get their money out in a short time period, right? So if it's say, hey, yeah, I can get your money out in 2 weeks. Well, does that 2 weeks really reflect, the size of the loans? Does it reflect the size of the funds? Does it reflect the terms of those loans, right? So if you're looking at a deal where there's, a year to 3 years in the loan terms, and let's say the fund is, south of 25 million or $25 million, and let's say it's $15 million, and you put in $1 million and like, yep, we can get your money out in 2 weeks. Well, to me, that's kind of raising red flags that there's probably some leverage on there. And then if they said to me, well, you're sitting first position, well, in reality, you're not sitting first position. And if anything were to happen at that point, whoever is whoever owns that credit line, so like a lender or a bank, they're really sitting first position and not you. Another way that debt funds utilize this is they take your money and then they go to a lender and they say, hey, here's $100,000 and I'm going to take out a loan for $300,000. So they basically use your money as a multiplier by other loans. Again, it doesn't put you in first position, and you should be very, clear on exactly what that is when you're evaluating. The last kind of key topic that I always make sure to ask about, and really get some details on is whether or not the debt fund manager is aware of the foreclosure proceedings. So again, we're talking about real estate here. Defaults and foreclosures, they're really a part of the business, right? And if you're making loans in the real estate area, so it's not necessarily saying, well, we've had no foreclosures. It's about saying, how have you limited those foreclosures? And if you do have to go through those foreclosures, how well do you know the proceedings in the states that you're doing businesses, right? And I think some of you already know this, but really there are two types of foreclosures that are out there. There is the judicial foreclosure, and then there's the non-judicial foreclosure. A judicial foreclosure is the process by which a lender obtains a judgment to foreclose in a court. And I believe that's available in almost all states that have kind of that process. But some states have a non-judicial foreclosure process, which basically means you don't have to go to court. And there's other proceedings that you actually have to go through, not as expensive as court and probably not as lengthy as court, but that you have to go through in order to close on the products. And that's where you see things like, hey, you have to be listed in the local newspaper for 2 weeks. So you have to pay for that ad and you have to file some certain things. But what's important here is that depending on the state that this debt fund is actually working in, you want to make sure that they understand if it's a judicial or non-judicial state, and then specifically what those proceedings are and how much that costs, so they can already kind of bake that into the actual operating expenses of the debt fund. So I know this isn't an exhaustive list, but these are some of the critical pieces that come up when I've been talking to investors or when I've been talking to other debt funds and just kind of hearing around the market of what's going on. Now, this is great when you're starting into a debt fund and you're evaluating things. But what happens when you're in a debt fund and you're like, you know what? I'm not really sure if everything's going copacetic. I'm kind of hearing some rumors of what's going on. So what I'd actually like to share now is, issues that maybe can signal some trouble. And this isn't to say, hey, everything's in trouble, the house is burning and everyone's got to get out. This is more about, when do I need to ask a few more questions? When do I need to get drilled down a little bit more? And I need to ask for more financials to really kind of understand what's going on with my debt fund. So put together just a small little list here of things that, I've seen occur that really you should start asking more questions that if you start to see this. So the first piece that I have on here is lower than expected demand for loans. So I think, just like everything in the economy, the loans that we're doing and the debt that's there, it's cyclical, right? And sometimes that cycle is very short, sometimes that cycle is very long. But what happens when that lower than expected demand for those loans occurs? And when people start saying, hey, we've had a lower than expected demand, such and such and such, that's when you should start asking questions like, okay, I understand the traditional way that you've done things in the marketing and you're selling is a lower expected demand. What are you doing in order to make up for that demand, right? So that should be the next logical question that you start asking if you start hearing words like, well, the demand has gone down. Because in reality, if the demand goes down for those loans, that's where you don't see necessarily those distributions coming through in a couple months or a year or so. The second piece that I've heard quite a bit about is increasing in non-performing loans. So again, not saying that this is the house is on fire and everything's burning down, but it's just kind of saying, hey, we've had some non-performing loans and we've seen an uptick in that. In a lot of cases, when you look at a debt fund, you look at basically the entire loan portfolio that they might have, they're always going to have some percentages in there that are always fixated on non-performing loans, defaults, and so on and so forth. But as those thresholds start to get, approached and then passed, that's when their business model starts to break down a little bit. And so you need to make sure that, okay, if you do have non-performing loans that are occurring, what are the next processes? Let's talk about the foreclosure processes that are in place for this state or for these specific areas. Or what are you doing to make sure that, hey, they're non-performing at this point? How do we get them back to performing? Or what's the extra point down that you're asking them to make? So it's really trying to get into the next level of questions when you start hearing that non-performing loan conversation start. Another one that I've heard of, and it's interesting because I was just on a call with our debt fund managing partners, and when we talked about some of these, if we ever get into a non-performing loan situation, we look at the loan criteria and we make it tighter. Well, in some debt funds, and what I've heard is that, well, in reality, we don't have as much demand on the loans, so we're actually going to loosen that loan criteria a little bit. Maybe we're going to, get the LTVs up a little bit more. Maybe we're not going to ask for much down on those pieces, so they can still continue to make those loan pieces. So I'd be very careful if you start to hear that, maybe we're updating the loan criteria to make it become more loose or make it become more friendly so they can drive more demand. That's another area where you're saying, well, hold on a second. It seems like you're stepping away from either the lessons learned that you've created that loan criterion, or you're trying to drive more business by bringing in, let's say, less qualified either people or less qualified assets into this that is going to, at the end, probably end up causing you defaults, or excuse me, well, yes, defaults and foreclosures, but also not making those distributions. So again, make sure to, try to listen very carefully to see if there's any of those loan criteria actually is getting shortened. Another piece, and this doesn't happen as much, but change in redemption timelines. So it's not necessarily saying that, we're going to full scale, like, hey, from 90 days to 180 days now of those redemption timelines. But it's also about saying, like, hey, we normally get these redemptions out in 4 weeks. Well, now it's 7 weeks. Yes, you're still in kind of your timeline, but why has there been this change in 3 weeks for those redemptions? So it's another piece just to keep your ear to the ground and have an understanding of what's going on. Again, a lot of these pieces can be explained, with logical explanations, but if you start to feel a little like, hey, that doesn't really sound right, it might not be right. Next piece that I would say is kind of a sign of trouble is when the management turns over. So one of the key pieces, and I pointed this out at in the last list that I put together when evaluating a debt fund, you want to make sure that the management, each one of those managers that are in there brings something to the table. It's either experience in that specific area or experience in servicing the loans, it's experience in marketing, all of those pieces. When you start to see the top line management start to turn over, that's when you start losing some of that experience. And you want to be careful in terms of, well, okay, maybe it's the person that leads the networking. Okay, networking we can kind of get over. But if it's the person that has experience in hard money lending for 20 plus years, and they are the sole base of information for, let's say, if you're doing single family flips, that they are the ones that did the 800 flips, but no one else on the team has done that. That's when you should be a little bit more concerned to start asking some deeper questions to say, how are you going to fill that knowledge gap? Why is this person leaving, and what is the plan moving forward? So again, it's another one of those pieces that sounds very logical, but it's just make sure that, when you're listening to updates on the debt fund that you're in, that you're paying attention to. And the last piece that I wanted to call out is really no plan for anticipated market shock. So I put anticipated market shocks in there because no matter what, there's going to be market shocks to any market on earth. It's not like everything's going to be smooth sailing. You provide me a market that has never had any market shocks, and I'll buy you dinner if you want to come to Chicago and join me in the cicada infestation that we're currently having. But one of the key pieces here that if you start asking some questions about, okay, what happens if interest rates go up, right? What happens if, wars continue and the US gets pulled into more conflicts on those pieces? I know it's some high level thinking, but each one of those pieces is going to have an impact on that fund in some way or manner. Maybe not, it's going to change the whole business criteria, but there's some are things that need to be thought about that if you're running a debt fund, and a large debt fund at that, that you really need to understand how those things impact the business. So if you start asking questions about like, hey, what happens if interest rates go up or they stayed level, what are we going to do? There should be plans in place, or at least a logical explanation of what they're going to do moving forward. So I'm going to switch over here and just kind of look at some of the questions that we may have had that have come in. Let me stop my share real quick. Let's see. All right, we've had no questions come in. I'll give a few more minutes here to see if anyone has any additional questions. I hope you've really learned a lot from this. I know obviously some of these seem to be very logical in terms of what the lists are, but it is one of these things that I do hear a lot. I hear one in questions about our debt fund, but also I get asked a lot of questions about, hey, look at this debt fund. Are they using leverage? So it's making sure that we have some of those information as we're going. What should be the fees associated with managing a debt fund? So that's a great question. So these are obviously going to vary across the board in terms of what those fees are. And I'll speak to kind of our fees on our debt fund, which is we go in and we take first position loans on rehab projects. So there's the fees to the borrowers on the debt fund, right, that we charge for them to actually make it. We then have a management fee that we fit in, and it's not necessarily just a general fee across the board. It's really the expenses of the debt fund. So that's another thing actually we could even add to our list is, you should be asking what the expenses are and understand kind of what that is. If there's a lot of additional fees that go on top of the expenses, I think that's where you should be wary in terms of, explain to me why you charge that fee and why can't that fee or those dollars that you're associating that fee come to the investor? Again, this is one of those situations that if it seems uncomfortable, if it seems kind of out of whack outside of just traditional the expense ratios that they have, you need to maybe take a second guess at what some of those fees that are being charged in there. Okay. Well, I don't want to take too much more time of everyone at this point. I hope you've been able to learn something. Please tune in next Tuesday when we have our next education. Whitney will be back. But again, if you have a chance, please check out passiveinvestingwithwhitney.com. Again, she's got a bunch of resources that are good. And in reality, schedule a one-on-one meeting with her. She's great at kind of helping if you're unclear and really why you're in passive investing, but your friends are talking about it or you should do it. Set the time up with her. She's great. She bounce ideas off of her, and she's been able to put a plan together for me, even and my family, to really say, oh, okay, now it's more clear. Now I understand what it is that I want to do. She just really has that great experience in terms of doing this for herself and really helping a lot of our investors kind of set that up. So I hope everyone has a great Tuesday, and I hope to speak to you again soon. Thanks, everyone.